Afternoon, everyone. We meeting today for the May 29th special called meeting of the CERS Investment Committee. We have several things to focus on this afternoon. We have reports about the national economy and the capital markets, report about the performance of the CERS investments, and we have one possible action item regarding our IPS. So with that, I think we can get started. So I'll call the meeting to order. And the opening statement, Eric, if you'd be so kind to read the opening statement, I appreciate that.
Of course. This is a special meeting of the County Employees Retirement System Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If the connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you. Sherry, would you please take the roll?
Yes, sir. Dr. Hackbart,
Here.
Mr. Cheatham,
Here.
Mr. Fulkerson, Mr. O'Meara,
Here.
and Mr. McGraw.
Here.
Thank you.
Thank you, Sherry. Were there any public comments for today's meeting?
No, sir. No public comments for today's meeting.
Thank you so much. We have 3 sets of minutes to approve this afternoon. I will take them individually. The first set of minutes were for the February 25th, 2026 meeting. Hopefully you've all had a chance to review those. If someone would be so kind to move acceptance, and if there are any changes, we can make those adjustments. Would someone please move to approve the February 25th, 2026 meeting minutes?
Move approval.
Second.
Second, thank you. Any comments or suggestions? If not, we can proceed to vote. All those in favor, please signify by saying aye.
Aye.
Aye. Opposed? Motion carries. Move on to the March 25th, 2026 meeting minutes. Again, would someone make a motion to approve those minutes?
Move approval.
Thank you, Bill. Is there a second?
I'll second.
Thank you. Appreciate that. Any comments or suggestions regarding the March 25, 2026 meeting minutes? Hearing none, we'll move to vote. All those in favor of approving the March 25th, 2026 minutes as presented, please indicate by saying aye.
Aye.
Opposed? Motion carries. And finally, the April 28th, 2026 minutes. Would someone please move to accept those minutes as presented?
Move to approval.
Thank you, Bill. Second, please.
Second.
Good. Thank you. We appreciate that. The motion has been made and seconded to approve the April 28th, 2026 meeting minutes. Any comments or suggestions about those minutes? Hearing none, we'll proceed to vote. All those in favor, please indicate by saying aye.
Aye.
Aye. Opposed? Motion carries. Minutes, all 3 sets of minutes are approved. We'll begin with the capital markets overview. And David, would you please begin that presentation?
Sure, thank you. First quarter, this is an overview of the first quarter, but we'll touch a bit more on sort of where we are to date post the first quarter. And I'll just, I know Steve's going to go through performance and show market returns across equities, fixed income, et cetera. So I'll just say this about the first quarter. The first quarter was a -1 for equity markets in the U.S., down about 4%. Outside of the U.S., down also, much less than the U.S., and essentially 0 for investment grade bonds. All that is deeply in the past. We get to April, we have a plus 10% to the U.S. equity markets and another 5% here in the month of May so far. So quite a turnaround, and I'll just leave it at that and talk about the things that we're paying most attention to. Sherry, if you could go to slide 27, please. So, if you look at the title, we say that the first most important issue today is this U.S.-Iran Strait of Hormuz situation. Second most important issue is the same thing, and the third most important issue is the same thing. So, as we look at that, we certainly cannot predict where the outcome to all of this is, et cetera, but we can just talk about some of the economic impacts and that it has. And so that the top panel, this is a chart of the flow of tankers through the Strait of Hormuz, and the dashed line right there around February 28 is where everything shut down from this conflict that is going on. So the blue bars are the Hormuz tankers flowing through the Hormuz. So obviously everyone knows that's been essentially shut down, and a few fits and starts here and there. But our thinking is, so there's impact on the economic impact from all of this is the flow of energy. About 20% of the world's oil flows through that Strait of Hormuz. And so those are the things we're keeping an eye on. It impacts rates, it impacts inflation. I'll show some of that in a minute. But interestingly, the second down panel, this is the market's prediction of when that will return to normal. And this is, as of the end of the quarter. So predicting out by the end of April, there was a 21% prediction probability that flow would return to normal. Well, we're a solid month beyond that, and we're still, not there. So that 21%, certainly a low prediction probability, was in the ballpark of what did play out. The third panel at the bottom is predictions of when the end to the conflict might be announced. And you can see with the red line that June 30, it was carrying about an 80% expectation that by then it would be concluded. So we have exactly a month to go. We'll see how that plays out. But that's just a little bit on that front. If we go to the next slide, 28, we can see the impact on rates in this slide. And so these are break-even rates. So break-even is the break-even between nominal treasury bonds and inflation-linked treasury bonds. And so we're looking at essentially that break-even rate is the market's prediction for inflation. And if you just go all the way out to the right to the dashed line, the green spike, that's the short-term spike. So at the time of all the conflict, right away, the market perceived, that's a 1-year prediction in the green line, very high inflation up over 5%. That's already dropped down significantly, along with the equity market rallies that we've seen since then. So just interesting data. One thing we'll say about it is, as you look at all the other lines here, the 5-year, the 2-year, the 10-year expectations for inflation, all sitting around in that 2% range. So even, the market's perception has been short term, we're going to drive rates, and longer term, it's going to, be more settled. So interesting just to see how the market is reacting to all of this. If we go over to slide 29 and look at the Fed here for a bit. So when we cut this page, we titled this that the Fed funds implied rate had shifted from easing to neutral. And for anyone who's been paying attention to this, you saw that happen. Well, we've now already shifted beyond that into an expectation for hikes. Just given the growth that we have in the economy, given the inflation that is coming through, and particularly from oil and other things, expectations are that the Fed will probably pivot and end up raising rates. So if we look at this today, I just updated today, Fed's funds rate today, the range is 350 to 375. And by the prediction today for a year, roughly a year from now, end of March, is greater than 50% that Fed funds rate will be higher. So point is, we're seeing rates looking higher. And this is a real change from where we were 6 months ago, 9 months ago, with an expectation that the Fed would be slowly trying to get down. It's going to be an interesting challenge because there's a lot running hot in this economy, and there's a lot going on with inflation related to these exogenous factors with the war. So we'll see where it goes. But the final couple of slides, if we go to page 30, one thing really interesting in all of this, see, everyone's been well aware that we've had an inverted yield curve for a couple of years now. We are starting to shape positively sloped on the yield curve. The bottom chart, that red graphing is the 2-year minus the Fed funds rate, which should, in a normal environment, be positive. And that, for the last couple of years has been running negative. And at the very far right where you see it circled, we just had a blip up in that, and that we now have a 2-year that is higher than the Fed funds rate. So, I think it's kind of a meaningful time that after about 2 years, we've crossed into potentially going back to a positively sloped yield curve. And that is still the case today if you look out at where how the yield curve is positioned today. So interesting there. Finally, in page 32, where we look at the 10-year, the top chart is the nominal rates. Again, we have a dashed line where the conflict began, so over there at February 28. And you can see rates really jumped up pretty quickly with a 10-year nominal and then cooled off a little bit. We've gone up over 50 basis points in the 10-year. The red right below that is the real interest rate. So that's nominal minus inflation-linked bonds. And you see the same thing. So I'll just do one more page. If we go out to page 33, we zoom in on this. And the point of this is to show that, so that top line is the 10-year nominal now in blue and its rise. And then in red is the real rate. And then down at the bottom in green is break-even inflation. The point of this chart is to show that as rates have climbed in this recent environment, the majority of the increase is in the real rate. So meaning that expectations, as the market is pricing into bond markets, it's pricing in expectations that inflation will be higher, and inflation is driving rates higher. So we just find that to be very interesting to see the real rate be the majority. It's about 85 or 90% of the increase in the nominal rate is caused by how the real rate is pricing. So expectations are for higher rates. Expectations are that the Fed will hike rather than cut. Expectations are for higher inflation. And leave all that on the table of the Fed to try to balance all of that. But back to the first slide, the most important thing is where we go day by day with this situation with Iran and the Strait of Hormuz. So we wish we could predict that for you, but we can't. But we keep an eye on what it does to markets and how it impacts asset portfolios. So I'll stop there, and if there are any questions, take those. If not, you can move forward.
This seems that one of the questions that's out there is what direction the new Fed chair will try to take. I assume he's under pressure to lower rates as opposed to increasing rates, at least from the administration. So it'll be interesting to see how he reacts in trying to lead the Fed in terms of his policy going forward.
Yeah, absolutely. Yep. I think we're already hearing that even he is expecting we're probably raising rates before we're lowering again. So it will be interesting to watch.
I think the other issue is how long is it, assuming that the strait is open by the end of this month, which we don't know, how long the effect of the closure will have as going forward, how long we'll get through that impact.
That's right.
Oil prices and on inflation and so forth. That's the other unknown, strikes me. Mm-hmm.
Yeah, I think so too. I think there'll be a lag effect of some amount of time that will probably be keeping prices higher going forward for a period of time.
Well, and specifically with the Fed, I think, we forget about the dual mandate, right? And so I think David's done a great job, but inflation is certainly the focus. I mean, I think we look at recent labor market indicators really showing, I would say, a stable to maybe even a modestly improving job
Right.
market. And that's really going to allow the Fed to keep policy steady or to potentially raise rates, focus really on that inflation side of that dual mandate. So I think that's going to be the interesting tension as the year moves forward.
Good
Agreed,
point.
Steve.
The
Yeah.
labor markets are stable. I mean, in terms of, I mean, it's amazing. I mean, probably unanticipated, unexpected. Yeah. And it's probably
Mr.
not
Shannon
major
has his
indicators.
hand raised.
Mhm.
Dave, just a couple of questions. Given what the markets are telling us with regard to interest rates, as far as a potential hike, when 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 would you more likely than not expect to see that? In, third quarter, fourth quarter, first of the year, what? And
Right. I
then,
think, this is kind of moves almost daily in terms of how the market prices this. I believe right now the market has priced in a hike by year end, but that could be different a week from now.
Yeah, it's come down a little bit. It's right now, December is pricing in about a 36% chance of a hike.
based
Yeah.
on the current rate expectations, then what's Wilshire's stance with regard to duration?
How exactly do you mean that question?
Well, do we need to be focusing on shortening our duration,
Oh, I see.
lengthening our duration? What?
Right. Yeah. Our view on that would be way too hard to call that, especially in the short term. So we would not bet on duration. Just in the environment that we're in, we would stay close to whatever that benchmark rate is. If you're, for investment grade bonds, that's around 6 years. But it's just not an active position that we would take right now because we think it's way too hard to predict this, especially with everything so much that is driving this that is outside of normal market behavior.
Okay, so you all don't have a longer term stance, or are you saying that you would focus on shorter duration given the uncertainty?
Well, our longer term stance, it kind of maybe move it up a level and compare investment grade fixed income. So like core bonds compared to equity markets. If we just raise it up to the equity risk premium, we are still holding a higher expected return for core fixed income over the next 10 years than we do, say, for US equities. So that comes a lot from the valuations that we have in the equity markets. I showed that because then I would say from a policy standpoint, you have X% in your target policy to investment grade fixed income, we'd still be there. We wouldn't shy away from that. But duration in the short term, we're not being tactical about it right now because we think the rewards or the amount of volatility and risk you're taking to make that bet are not commensurate. So, if you have X allocation to core fixed income, keep it in place, and benchmarks probably, portfolio is probably close in duration to the benchmark.
Okay, going to your discussion over the issue of Iran and the Strait, outside of oil and fertilizer, what other material sectors are you seeing that are being impacted and could continue to be impacted?
Sure. Consumer goods, food, certainly seeing inflation impacts in all of those areas. Technology, so much is being driven by the whole AI effect until what that does, but inflation, across a number of things can be present today, especially in food and energy.
What was that I saw? Was it yesterday or the day before? The president of Exxon is, you know, talking about $150 oil price by July.
Hmm.
It, I think the big question at this point is even if you waved a magic wand and opened up the strait today, how long is it going to take to get back to normal? And a lot of these, based on what we saw the last, few years with regard to inflation, just how sticky is this inflation going to be? I don't know that I see
Right.
a lot of price drops coming.
Yeah, it's really hard. It's hard to know, but if you override that with the fact that our markets today are reacting daily to news flashes about just about anything. So all that has to be done is to say that the war's coming to an end or tankers are going to flow, and suddenly, oil drops 10%, et cetera. So it's really hard to balance that with where do we all think oil might be in 6 months or a year, because at some point this crazy noise will work its way out, and then we'll settle on has oil adjusted to where it should be, say 3 or 4 months after all this event is over, if this event is over. So
It seems that Iran is in a very strong position, negotiating position, and the ability of the administration to work out an agreement with Iran may take a long time.
hmm.
And we hear these periodic announcements which tend to be optimistic, and then we hear again the next day that nothing's happening. I think they're trying to persuade the American public that there's some optimism, but if we look at the record, what's happening, I think we need to be prepared for a longer period of time to deal with this issue, and it's unfortunate that we got involved in it at all. Maybe it was a choice.
What it hasn't there going to Dr. Hackworth's point, I think, isn't there a pretty significant divergence in, the market price for oil versus, what is actually being reflected in, actual physical purchase price of oil? You know, I'm seeing reports that, yeah, we're looking at the options on, prices and whatnot on oil are, $9,500, but if you're actually out here buying oil to uh, you know, it's running 140 to 150. Is that a thing or is that not a thing? I guess is the first question, David.
Yeah, and I don't know that we have the answer to that. I mean, there's certainly um, sort of a spread there that can exist, and that can, so many of these things right now in this environment are moving daily in a significant way. So it's hard for us to know the specific answer to that, but we see, just like you see the price of oil, even WTI dropped 10% overnight, and it could go back up 10% the next day. That's what we're facing today.
Yeah, we're not facing economic trends here. It's another phenomenon, and I'm sure there's a lot of speculation in the market, basically, as we're
Yeah,
talking
sure.
this afternoon.
Sure,
Who knows?
exactly. Speculation everywhere. Yep. Yep. Good thing about your portfolio is, and maybe this will lead to where Steve's going, but you're well diversified and you have exposure to growth assets. You also have exposure to inflation sensitive assets. And, that's a big part of the balance.
I think that's exactly why we do diversify. I think bigger. I guess my question, and maybe it's not the right one to ask, because we are certainly long-term investors, is, with the uncertainty comes opportunity. Where are some of the opportunities, even if they're short-term opportunities in your all's book? And is it worth us looking at that?
Right. You know, we had, if you just kind of look at our book and where we actually take positions, we've been really light on that the last quarter and a half because of when things are this volatile in the short term and affected by exogenous factors, it's really hard to try. You have to measure how much when we take an active position on anything, it's risk measured, and those risks are really high right now. Just like you mentioned, duration. Anyone might have a view on that and take a position to be short or to be long, but the risk associated with that position is extreme right now. And the same with betting on oil and inflation. Um, I mean, if this extends long enough, this could lead to a recession. So it's those are really really big changes that can occur in a short amount of time in this environment.
Okay.
Most likely to be tremendous political pressure on the administration to seek a solution before the election. I think that's the big issue that's out there in terms of how they react in that environment. They may accept a less than optimal solution just because of political pressure.
Yeah, I would add to David's comments. I think you hit the nail on the head. I think the focus on real assets in the current environment, which obviously those are investment recommendations that we've been making recently, and then as we've been focused on for a while, assets with a yield component, investments with a yield component. Duration, as I said, you don't even find a lot of active core managers that take a lot of duration views. It's usually a very difficult trade. I think there's rare opportunities. As we saw, we were very short duration coming into the significant rise in yields. And where we are now, I think yields are attractive. I think so anything with a yield component to it is an attractive investment. There may be some volatility around potential hikes, shifts in the yield curve as we've seen with the 30-year. But I think longer term yield is attractive right now.
Yep. Agree with that, Steve.
David, do you have more to present?
No, that's it for now. Thank you.
Well, thank you. Thank you for your comments and insights. We can move on to the CERS Quarterly Investment Review. And Steve, please proceed.
Thank you. Page 57, please, Sherry. And first, I want to take this opportunity to introduce Colby. I believe Colby is still on the call, who has joined the Office of Investments as our summer intern. So welcome aboard. And David did a great job of hitting the highlights. I think some of this, unfortunately, some of my comments might be a little repetitive, but I just want to hit home how they relate to the portfolio, especially. The quarter, as he mentioned, was a negative performance overall, but it really was a tale of two halves, right? With risk markets producing solid returns in January and February, and only to give it all back in March, as global markets navigated that volatility, which was dominated by the conflict in Iran, still to this day is. Oscillated almost daily, continues to oscillate daily between escalation and de-escalation, which as we've seen is whipsawing energy markets and risk markets more broadly. As David mentioned, oil has been extremely volatile. He had a great chart to the disruptions to the regional shipping and energy infrastructure that has really been the leading cause of the higher oil prices. And global equities reflected that broader risk-off tone and the worsening sentiment, as he touched on again, with monetary policy expectations re-rating significantly in response to those higher inflation expectations. So we don't hear the word transitory much anymore. I think that's been tossed out for a long time. A lot of the influences on higher inflation were transitory. I'm not sure that's going to be the case anymore. Artificial intelligence related disruption was another big topic during the quarter, remaining top of mind with software and memory stocks selling off and concerns growing about exposure, especially in private markets. We did see several semi-liquid private credit funds reporting repurchase requests that exceeded their 5% NAV quarterly thresholds, causing stress in the markets. And consistent with this backdrop, after posting positive performance in January and February, the portfolios declined in March, pushing overall performance for the quarter into the modestly negative territory. The CRS pension composite produced a return of minus 97 basis points for the quarter, outperforming the blended benchmark's total return of minus 1.38%, while the CERS insurance composite produced a return of minus 1.01%, also outperforming the return of the benchmark by 32 basis points. Individual portfolio performance for the quarter ranged from down 95 basis points to down 104 basis points, with all of the portfolios individually outperforming their respective benchmark by between 29 and 41 basis points. During the quarter, the largest contributors to outperformance were the relative performance in the real return and specialty credit portfolios. The specialty credit portfolio produced a return of 42 basis points, outperforming its benchmark by 94 basis points. And that was with 15 of the 17 portfolios outperforming their respective benchmarks, being led by the opportunistic credit strategy that outperformed its benchmark by 240 basis points during the quarter. The real return portfolio outperformed its benchmark by over 450 basis points during the quarter, with exceptionally strong performance in the portfolio's MLP, toll road, and infrastructure strategies. That was partially offset by the largest driver of underperformance during the quarter, which was the overweight and the relative performance of the public equity portfolio, which trailed its benchmark by 27 basis points. Fiscal year to date, the CRS pension composite produced a return of 5.47%, outperforming the blended benchmark's return by 37 basis points. While the CRS insurance composite produced a return of 5.30%, outperforming the blended benchmark's return of 4.98%. Through the first 3 quarters of the fiscal year, again, the real return portfolio produced 811 basis points of outperformance, while the specialty credit portfolio has outperformed its benchmark by 217 basis points. So strong performance in both of those portfolios. Again, this has been partially offset by 152 basis points of underperformance in the public equity portfolio. And as I'm sure Wilshire would agree with, the public equity performance is, underperformance is not unique to the CRS portfolios. As we all know, active managers globally have really struggled to keep pace with the performance of the indices, leading to underperformance of actively managed portfolios.
Yes, we strongly agree with that, Steve.
David covered a lot of this, but public equities reversed sharply in April. U.S. markets, as he mentioned, were up over 10%, non-U.S. markets up over a little 9%. The MLP index was up over 4%. High yield bonds and loans were up almost 2% for the month, while core fixed income was flat as yields rose across the curve. Hopefully, April performance should be finalized and distributed next week. So while the numbers are still preliminary, the portfolios performed as expected well in April, indicated up between 5 and 5.5% for the month, which would bring fiscal year to date returns to between 10.75 and 11.25%, with continued strong performance relative to their benchmarks. In May, we've seen that follow on to April sentiment. The cautious recovering, but volatility is remaining high. As of very recently, as I checked the screens, U.S. equities are up about 5% for the month, with tech leading the way up over 8%. Global equity returns are modestly trailing those returns. And as David mentioned, notably, however, global rates have sold off this month, with the 10-year peaking at 4.67% and the 30-year peaking at a 19-year high of 5.18%, before more recently settling back into a trading range. Broadly, we remain cautious in this environment. Reversals in stock leadership and elevated stock-specific risk continue to be key themes. Options markets reflect expectations for this to continue, with the CBOE S&P 500 dispersion index rising to 40, which is almost a 10% increase year to date. In the 90-day rolling correlation between the S&P 500 and the U.S. bond market volatility index has reached its most negative level since 2020, which really suggests that equities are increasingly sensitive to that bond market volatility. David did a good job covering inflation expectations, but as he noted, they're expected to cool later this year and move closer towards the Fed's target by 2027. But having run significantly above that 2% over the last 5 years, further increases are likely to occur as a result of the conflict in the Middle East, with emergent price pressures, as we've seen recently in a few categories that really appear unrelated to tariffs or energy prices. So inflation could be more persistent than anticipated and become a salient risk. Markets remain driven by that intersection of geopolitical uncertainty, rising inflation expectations, countered against the AI-led equity rally. Investors are weighing the ongoing Iran peace talks against the risk of central banks shifting back toward tighter policy. As I mentioned, as of right before the start of the meeting, the rate of a December hike was up to 35, and that's up from just 3% at the time of the June meeting. So really a material shift in expectations in the rate markets. For now, the path forward looks uneven, I think. Uncertainty is feeding into rate expectations, and that higher for longer environment, which really makes investments with that yield component more attractive, seems unlikely to go away anytime soon. We're here on the last day of the month, but early indications show the portfolios are up about 2% for May. So again, another positive month. Page 59, please. Briefly touch on a few of the additional parts of the presentation. The internal portfolios have all performed in line with expectations and objectives during the quarter and fiscal year to date. Again, most of these portfolios are passively managed and intended to replicate the risk and return of public market indices, providing inexpensive beta exposure to more efficient markets while providing staff flexibility and rebalancing the overall portfolio asset and risk allocations. Page 65. A couple of highlights from the quarter in the last 2 months. Staff continue to actively negotiate fee schedules with existing external managers. Staff was able to successfully renegotiate management fees with a public high-yield manager, lowering fees by 12% and saving the systems an estimated $500,000 a year. The majority of assets that were transferred in kind into the new Oaktree managed public leveraged loan accounts. Given the nature of these assets and the long tail, final transfers are expected to occur by the end of June. Based on the continued attractive risk-reward profile, compelling market opportunity, and real return allocations, staff recommended an additional commitment of up to $100 million to the IT Rail Fund to be shared among all CERS portfolios. This recommendation was approved by the investment committee and the board. Also approved by the investment committee and the board was a recommendation that staff made to transfer asset management responsibilities for the MSCI ACWI ex-US public equity mandate from the Franklin Equity Group to the ClearBridge team within Franklin Templeton. As noted in the presentation, this change is expected to improve the quality of the overall international portfolio with improved performance, less risk, and similar growth and lower tracking error. I'll pause there for any questions and then turn it over to Joe to discuss the public equity portfolios.
Any questions, Steve?
Just how's that process going as far as moving from Franklin to ClearBridge? And when do you expect that to be completed?
I'll have Joe comment on that. He can provide details. He's been intimately involved with legal and working through the documents.
Okay, well, let me add my second half of my question.
Sure.
And address that too. Since we're talking about the global or international market here, given the environment and the somewhat expected environment, how do we feel about global and international equities, and for that matter, bonds going forward?
Globally, on the bond front, and Brian can certainly add comments as well from the fixed income perspective, but we're seeing the rate expectations globally, right? So global rates sold off, and that's kind of an expectation that central banks globally, with a few exceptions, are more in the hiking mood than the cutting mood. So, we've seen obviously muted returns for fixed income, but yields again are attractive on a global basis. I think the concern with risk assets broadly is the growth profile, especially with higher rates, U.S. versus non-U.S. We've had a modest overweight in the non-U.S. portfolio We've kind of dialed that back. I think Joe can comment where the current positioning is on a U.S. versus non-U.S. basis, but I think it's really going to be driven by both rate expectations for central banks globally, as well as growth expectations and what inflation's impact globally has. The U.S., as we mentioned at the last investment committee meeting, from the energy dependent standpoint, obviously has a lower dependence on external energy than some parts of Europe, which obviously is with inflated prices is going to hamper growth, hamper consumer spending, and potentially lead to more muted returns, at least in the near term.
Yeah. As far as the transition from Franklin Templeton to Clearbridge, we're in that process. The documents have been agreed to. Accounts are being opened up at BNY Mellon with a target date of June 15th to fund those accounts and to make that transition occur. So in the process, a couple of weeks from it being completed. And as far as international markets, I was trying to find the chart that I wanted to reference. I couldn't find it while Steve was talking, but essentially if you were to look at the last, I don't recall, 30 plus years, you'll see pretty similar performance between the U.S. and non-U.S. Obviously, there's times when different regions outperform the other. We've been in a period this last 10 years where basically 8 of those 10 U.S. dominated. That was a difficult period for us. International markets have done really well, actually, in comparison to the U.S. For the last 5 quarters, they've outperformed. We maintain a very modest overweight to the non-U.S. It's not very significant in that tend to be a little bit more volatile when uncertainty is in the market, and with the environment we are currently in, we did dial that back a little bit a couple of quarters ago, but maintain a very modest overweight towards non-U.S. versus our benchmark, and it's been a benefit for the portfolio for these last few quarters. So.
Joe, Steve, Dave, with that, what's your thoughts or expectations as far as the strength of the dollar going forward? I know a lot of that return in the international side of the fence has come from a declining dollar. It seems to have turned around a little bit in the last month. What's your longer term view?
I guess I'll just take it from we view it as a source of diversification, not necessarily a source of income, I guess. Long term, it's a zero-sum game, in our opinion. There's going to be periods where a weakening dollar will benefit the non-U.S. markets, and that will obviously aid in it. There's times when a strengthening one's going to hurt when it gets translated back to our local currency. It's another source of diversification that we, over the long term, kind of view it as a wash. We do not pay to hedge it out. That would be an insurance premium. That's just an expense that I don't think long-term makes sense. In the short term, it may from time to time, but we're long-term investors. We're a perpetuity. So we just view that as another source of diversification.
Yeah, we're 100% of everything Joe just said. We're totally lined up with that. Over long-term periods, we expect parity between currencies. Interestingly, we have concern about the level of the debt in the U.S. and rising rates and what impact that could have on the U.S.'s ability to pay debt service. So everybody sees that story, and we know that's significant. And in the short term, that could place pressure on the dollar as it's viewed as a safe haven. That said, as soon as this event broke out, the dollar was the safe haven again. So there's a lot of talk about it. There are a lot of people that talk down the U.S. dollar because of these issues. We recognize they're real, but again, long term, we believe there's parity. So we're not trying to time it.
And I would guess I would add to that, in the short term, obviously it's a component of the return calculation, whether the dollar is weakening or strengthening coming from our non-U.S. assets. But because the plans are in a better cash flow position than they were several years ago, that's on paper. We are not being forced to utilize the non-U.S. assets for any kind of benefit payments or anything. So Short-term paper fluctuations don't affect the funds dramatically from a cash flow perspective, so it doesn't. It's again just a long-term diversifier that ultimately tends to wash out. So.
Yeah, and I would echo David's comments. I think that's evident. We talk about that sustainability. I think that's, a lot of people point to that as the move in the long end of the curve recently. Obviously, that's less about inflation expectations and potentially more about debt sustainability. We look at DXY. I mean, DXY, to David's point, we had a good run. And we've kind of seen it flatten this year. I think probably 50 basis points, 60 basis points appreciation year to date. Again, I think on a near term, intermediate term basis, different rate differentials and growth expectations are going to kind of drive that. So, as Joe mentioned, I think our position is use it as a diversifier, position the portfolios accordingly.
So, David, going to your asset return assumptions, am I interpreting it right that, when we look at your expectations going forward of, international or ex-US assets, that you all don't have a currency expectation built into that number, or yes?
That's an unhedged assumption. So just like you invest in an unhedged approach, that's what that capital market assumption is. So we have a slightly higher expected return out of non-US equities, mostly due to valuation differences.
Okay. All right. That's helpful. Thank you.
Yep.
We ready for me, Steve?
Yes, Joe. Thank you.
Okay. So I guess if we'll go to page 66, I'm going to go pretty quick through the next few slides because I think David and Steve have covered quite a lot of what I was planning to talk about. But basically, the first quarter started off kind of where the fourth quarter of 25 ended, with a broadening out of the equity markets. It's something that we've been looking forward to for quite some time. Actually, the narrowness, we talked about a couple of quarters ago being a real headwind for our strategies. And so this was a moment where active management, we thought we're going to be able to really outperform. Started out the quarter started kind of that way. You saw equal weight indices beating the cap weighted. Small caps outperformed large caps for the quarter, which was notable in that that really hasn't been the case for several years now. Large caps were kind of the darlings. So small caps actually outperformed the mega cap tech names. Value outpaced growth, which was kind of a change of pace over the last few years. That all kind of shifted in late February, March, when the Iranian conflict kind of broke out. Strait of Hormuz closed. At one point, oil prices had doubled at their peak, and so the market really became a one variable market. And I think we spent quite some time on that. In that, if you look at the charts to the right there, you see oil exports through the strait basically fall off a cliff, and to the right of that, you see the oil prices ramping up dramatically, and then the inverse relationship with the markets dropping, and then you kind of see where oil came back down. I'm sorry. I'm hearing, sorry. Oil came back down. You see the markets recover a little bit. Pre-Iran, the AI story was what drove the market. Software, anything related to the software industry got hit really hard. Not so much from an earnings perspective, but just from a multiple and a perception of what AI was going to, the destruction that it might do to that industry. And since then, the narrative has shifted from everything's going to get wiped out to some things will be disrupted negatively, others won't be so impacted. And so there's a little bit more discernment in the market around those names. We talked about what opportunities might be out there. Anything in the electrical or AI infrastructure space seems to be interesting. Anything in power or energy generation as well. Defense and industrials. Some concerns. We talked about high risk software is going to be concerning to hold that. Any long duration growth that's priced at a high multiple right now while you're waiting for that growth to take place. If it's at a high valuation, you're probably kind of holding some pretty risky assets at that point. If we can go to the next page, international markets outperformed U.S. stocks during the quarter. They really performed really strongly in January and February. And then when the conflict broke out, international stocks fell in March by 11%. A pretty significant drop. However, the lead that they built up in January, February, they were still able to outperform for the quarter versus domestic markets. Growth forecasts still remain resilient. Central banks have held rates consistent with the concern of near-term inflation and a little bit of a talk of a potential hike towards the end of the year. Earnings growth forecasts haven't wavered. So I think the market still believes the conflict will be relatively short-lived. It is interesting, just mentioned the outperformance of the international markets for the last 5 quarters. The discount from a valuation perspective to the U.S. still remains pretty considerable, and that can be seen on the next page, actually top right chart, if you'll slide one more for me on the deck.
I just wanted to let you know, Dr. Hackbart has his hand up. Didn't know if he had a question on this particular page.
Okay.
You're muted, Dr. Hackbart.
I was curious what your impression as to why the international markets have been outperforming the U.S. for that period of time.
I think a lot of it comes down to valuation. They were trading at a substantial discount
Prior to that,
to the U.S. Prior to all that. The U.S. was trading at a pretty significant premium, while at the same time the international markets were at a pretty big discount to their historical trading valuations. So that spread between valuations had only increased over the last few years, and I think it had got to the point where people realized the risk in those higher multiples in the U.S. and what they could get in the international markets, and they started to invest and put a little bit more money to work there, and so that you saw that creep up in performance in the international markets, and unfortunately this additional volatility just kind of smacked them back down a little bit, hopefully short-lived.
So it's more of an adjustment rather than any economic factors which are driving that.
I think so. I think so.
I think flow data confirms that. I think you saw a rotation out of U.S. equities into. So it was based. I think to Joe's point, primarily on valuations, but money moved from U.S. equities to international equities.
Correct. And so on the next page, you can actually see that discount rate, or excuse me, the discount between the two valuations, U.S. and non-U.S., and you see that spread widening out. From a performance perspective, in the first quarter, our exposure or our portfolio was down about 3% versus benchmark down 2.75. This says stock selection strength. It should read stock selection weakness was the issue, particularly in the international markets, specifically in the growth portion of that portfolio, which we've tried to address with this change that we just spoke about earlier. The U.S. book of business performed in line with the benchmark. Stock selection was a little bit split. Allocation decisions had little impact on the relative performance during the quarter. International markets, we were down 1.2 versus 0.68%. This was, again, those growth mandates that we have talked about. We've made some attempts to make some corrections there. Some of that was partially offset by strong performance in our deep value mandate, and both dedicated EM managers performed well during the period. Through April, these aren't audited numbers, but they are, I guess they're the best that we have at this moment. We've seen a strong reversal in the market, so we've performed roughly in line with that, with about 9.8% up during the month of April versus 10.1. U.S. has been in line. Our non-U.S. book is up about 9.25 versus 9.7 for the month of April. This brings our 1 year to about 29.24% versus 31.6. Strong absolute performance of, like I said, close, just over 29% on the year. Relative still falling short. A lot of that, again, comes from the previous couple quarters of that 12-month period where we had the market narrowness, the headwinds that we had. I guess if you'll slide over one more, I may have told you, actually, yeah, one more, I'm sorry. So that 12 month, I kind of jumped ahead where we were in April. Steve had spoke about March being up 19 versus 20.6, and that is having to do with those individual strategy performances just not being able to keep up due to style and factor weaknesses. Low quality in the first couple quarters of that 12-month period really ran. We don't build portfolios with low quality as being one of the things we tend to try to invest in. We tend to try to have a higher quality portfolio, and when the risk on environment is running, it's hard for those portfolios to keep up. So some of that relative weakness we were offset by being overweight the non-U.S. markets. We talked about that a little bit earlier. Non-U.S. markets during that 12-month period outperformed the U.S. by about 7%. So while we struggled on a relative basis within those regions, having a little bit more money in those regions was a benefit to the portfolio. That's really all I had prepared today. Happy to discuss or take questions or whatever.
The only thing I know, Dr. Hackford and Bill both have brought this up in the past. I appreciate the look back and whatnot. I'm curious to hear from all three of you. You know, what are your intentions, plans, recommendations looking forward?
Okay. So looking forward, we talked about with Franklin Templeton when we made that shift to ClearBridge that we were going to take that as a catalyst or an opportunity to really look at our non-U.S. book. We plan to do that. Like the dedicated EM portion of the book is doing well. Our value mandates have done well. The growth mandates have struggled. We've addressed one of those. I'm having a discussion with the other counterpart next week about what's going on in that portfolio. So I like the team, I like the philosophy, I like the process, but they've struggled. It's been a difficult environment for growth in the international space. Want to hear what they have to say on that. As far as do they think this is going to continue to be a challenging environment or not? From the U.S. side, we've just added a few portfolios, not even been in there a year yet, so don't plan on making a lot of changes there. Our small cap has struggled a little bit in this last year from a relative perspective, but not concerned at all. What's driven that is a risk on environment. This is a model portfolio that is based on quality and basically throws out what they deem to be uninvestable securities and optimizes beyond that. It's provided an absolute return of 42%. So while it's down a couple percent relative, the absolute performance has been great. No concerns there. And so I don't have any real issues on the U.S. side other than shifting back to the non-U.S. We are going to use this year to really take a view of that entire exposure with potential changes to come there.
And I would echo with consistent with David's comments earlier, and the capital market expectations report that they provided in the deck. It's difficult to really advocate strongly for a significant overweight to public equities of the growth sector, kind of primarily on a valuations basis. I think it's a difficult market. So I think from a positioning standpoint overall, Joe's talked about kind of within that public equity portfolio, how he wants to position changes he's potentially looking at making. But from an overall exposure, we're kind of staying relatively close within that growth bucket, kind of very near our targets, maintaining targets. I just don't see a compelling opportunity right now to get over the skis. Seemingly, after that bit of volatility that we saw earlier this year in drawdown, markets were fast to recover. If we're going to hit all-time highs fairly consistently, I'm not sure that a significant overweight is the right position to be in at that point.
It's interesting, Steve. Over the last 2 or 3 years, there's been continuous caution about public equity, and they've continued to outperform other assets.
Correct.
Curious, right?
It is. Yeah. You're
After-
nail in the head. I think that
After a while, you begin to think maybe we are assuming different.
I think what's been interesting is the rotation in drivers in the market. And I agree. I think, as Joe mentioned, if we look at the major movers in the market, the big moves that the narrative has shifted to, wary AI, right? AI's negative impact potentially. I mean, we've gone back and forth on this. AI was going to be the savior, was going to, the efficiencies that were going to be gained was going to be spread, rising, the tide was going to rise, all boats were going to rise in the tide. Now it's been a little more differentiated. And so even within that AI narrative, we've seen a shift from, the stocks specifically that are benefiting most. And that's a difficult, especially from our ability to allocate to those exposures, those specific exposures and individual stocks, is that, that's a difficult, and I'm not sure it's really warranted in kind of what the objectives of the portfolio are. So you're right. I think it's, we can be cautious. I guess eventually we might be right. I think it's not a time that we're necessarily looking to underweight. As I mentioned, on a relative basis, I think we still find investments with a yield component. We like the up in quality trade. We like investments given where rates are and spreads are. I think that's attractive on an overall risk reward basis. It's a tough environment. I think the caution is more, we're not looking to cut exposure significantly, but I don't think we're looking to significantly overweight the growth category at the moment.
I think what history teaches us is that there are always new industries which drive the market in terms of overall growth.
Yeah.
And they're always emerging and so forth.
Right.
And so we get a little concerned about the fact that the lead industries in the last decade are not going to be the lead industries, the growth industries in the future. There will be new ones. And so I think we need to think about looking forward to think of it from that perspective that, I'm not sure that continually being concerned about public equity, I'm not sure that's necessarily accurate.
I guess the one comment I would say just is, while we have been cautious as far as from a valuation perspective, we've never been underweight
Right.
the allocation.
That's
We've
true.
always
Right.
had a
Right.
we've always had a cautiously. We're positioned, I guess you would say, a little bit offensively because we're overweight, but we've been cautious in the way we've gone about doing it. You've got large caps that have led the market forever. Then all of a sudden, this last quarter, small caps beat them. You had U.S. markets for several years winning. All of a sudden, 5 quarters of non-U.S. dominance. So we try to play in all spaces, try to be diversified, cautious with the valuation perspective. But we've always had a little bit pro equity tilt, at least within the portfolio.
Well, I think the reality of the last several years challenges us to continually review our asset allocation strategy, as opposed to overweight or underweight. I think what's our general policy? I think that's what we have to focus on to a great extent, given the fact that there will be overweights and underweights due to the market changes.
Yeah, that's obviously going to be the largest driver of performance, right? That asset allocation. So it's warranted to continuously have an eye on it, whether it's a formal review or just thinking about it.
Right.
Right, and I'll just build off of both what Joe and Steve said about the also not underweighting. So, we too, kind of like Steve outlined, thinking being pretty close to those targets is good. We spend a lot of hours talking about this with a lot of people, and we also are not underweighting these markets, because as much as we've continued to see this run, the natural thing to think is, gosh, we've got to back down a little bit. But look at what's driving it. The earnings have been strong. Earnings continue to be strong. So, for those reasons, we're also not going to underweight it. Just staying close to what are the right, kind of goes back to Dr. Hackpart, your comment. What's the right asset allocation? If you have the right asset allocation right now, we're pretty much sticking to that asset allocation.
Well, I guess one of the reasons why I asked that question is, assuming we stay on a similar trajectory with regard to public equities, for example, we're not underweight, but the appreciation going on in that area really takes care of keeping that asset out, that asset at target or better. So the question becomes, where does new money get invested? It doesn't seem that we need to be adding money to the public equity side. So at this stage of the game going forward, where do we need to be concentrating new dollars to go to? I know we're still underweight on our private equity, but where else? Or should we be focusing on core bond? What?
Well, so the most recent rebalancing activity, and we'll get the allocations here in a few minutes, and that's exactly right. So there's obviously the timing lag, especially with private markets, as to your actual ability to allocate and get capital called and invested. So we take opportunity when we do rebalance in the liquid markets, and that's core. So we're trying to maintain close to target on core and in that overall specialty credit. And the specialty credit, again, is the combination of both public mandates and private mandates. So maintaining those, I think has been a focus of rebalancing activity. But you're right, when you have, we also get hit with the opposite of that as the denominator effect, right? In times where we see volatility in public equities being the first one that are going to react, and typically the magnitude is larger. When they grow significantly, you become underweight those other asset classes. So, our focus has been to rebalance where we can to get close to target or on target with most of those. The other side of that coin is if we saw, as we have, when we've seen significant drawdowns in those asset classes, in public equities, it obviously has that denominator effect, and all of a sudden you're significantly overweight other asset classes. So rebalancing back to targets during those times.
Well, again, my question, where does new money need to go?
Well, I would base it on where our target allocations are. If we want to move towards target, as you pointed out, I think specifically for CERS, underweight in private equity with the offset being the overweight in public equity. So I think that, what's the relative opportunity set between the two? Do you have higher conviction in one asset versus the other asset on a prospective basis? Where are you within the ranges and the targets? If we look at where we are, again, I think Sherry, if you want to go to page 103 real quickly, that might be easier. Thank you. So you can see most of, this is as of the end of the quarter, most of the asset classes are right on top of their targets within certainly 1%. The two outliers are that private equity. So we've talked about the private equity being underweight and a corresponding overweight in public equities, which again are the two asset classes in our growth category. I think, as you mentioned, when we've either gotten flows in, which is not, that those tend to be distributions, right? We know we're modestly negative on a cash flow basis. So when we get distributions from one of these asset classes, or when we rebalance in the public equities of the liquid asset classes, we're looking to move the other asset classes closer towards our target. So we're trying to stay, obviously within the ranges. Right now, we feel that that's an appropriate place to be on target. Just looking at this as we've discussed with your pacing plan, the private equity is the underweight. So, as we all know, though, that the issue with that is that it takes some time to move, even after you've sourced investment opportunities, committed capital for that capital to get called. That'll take some time to move.
I guess my point is, it's fine to be meeting our targets. The question is, do we have the right targets? And I think
that's
a
a great question.
We ought to be reviewing periodically as opposed to just worrying about whether or not we're on target. I think the target, what we're targeting is an important issue. It's basically what I think as a board, that's the one thing that we need to be principally concerned about. And then in terms of role, in terms of staying within achieving that target, that's fine. That's an operational side. But I think the policy issue is the targets themselves.
What's it been, Dr. Hackford? 2 years since we reviewed it. Does that sound right?
It's been a while. I think that's right.
Okay. That may be something, David, that I think you all recommend we look at that every 3 to 5 years. Is that correct?
Well, sure, that's sort of a, a starting point, but often it can be more frequent than that. I think we have trying to think back, Steve, if was it 2 years ago we went through the last asset allocation or asset liability study? 20,
It was started a little over 2 years ago.
Yeah.
It was an extended process, and it was the full asset liability study and not just an asset allocation work. And I think there's,
Yeah.
I think in your policies as well, there's a timing element to it. I think it's prudent to review it on a timing basis, and there also can be based on, significant changes in markets, could warrant a review that's outside of, kind of what you might set as a standard
Yeah.
timeframe
Yeah.
for reviewing.
Yep. Yeah. So, maybe we talk about revisiting that this year. Often when you go through that, you don't have significant changes to your desired targets. Sometimes you do, again, like Steve said, based on changes in the market. But asset allocation is intending to be a long-term strategy for you.
I would think after we see some clarity in the Middle East and some clarity of what the new Fed looks like will be a good time to review that.
Yeah.
With no additional questions for Joe, I'll have Brian and Anthony. Brian will cover fixed income portfolios and liquidity portfolios, and obviously, given the time, we'll cover it at a pretty high level here. So, Brian.
Thanks, Steve. Core fixed income starts on page 70, but David from Wilshire's pretty much already covered everything on that slide. So I'll start on page 71. Thank you. Even with the rise in rates, the core fixed income portfolio was able to generate a positive return of a whopping 4 basis points for the quarter and 329 basis points fiscal year to date, outperforming the benchmark by 9 and 19 basis points respectively. CMBS, ABS, and MBS once again were the top 3 performing sectors for the quarter, with MBS leading the way, generating 40 basis points in total return, followed by CMBS and ABS producing 32 and 31 basis points in total return respectively. Investment grade credit spreads widened 11 basis points for the quarter on a combination of risk off tone and heavy market issuance of $721 billion of new issues. And just as a side note, preliminary numbers for April show the portfolio up 17 basis points. Next page, please. Thank you. The specialty credit portfolio earned 42 basis points for the quarter and just over 5% fiscal year to date, outperforming the custom benchmark for both time periods. Lower quality issues underperformed during the quarter, with double B, single B, and triple C rated issues returning negative 28, negative 65, and negative 126 basis points respectively. Next page, please. High yield spreads widened 50 basis points during the quarter to an option adjusted spread of 317. In March, high yield bond indices posted their first negative total return in 12 months and their worst monthly performance since October of 2023. And just as another side note, the preliminary returns for April show public high yield up 169 basis points. Next page, please. David's covered again a lot of these bullet points, so I'll just highlight the returns for cash for the quarter. Cash generated 92 basis points in return with the fiscal year to date producing just over 3%. That's it for me. I'm happy to take questions. Otherwise, I'll kick it to Anthony.
Talk to me about high yield, Brian, where we think we're looking going in the short term.
As long as the economy continues to be robust, I think high yield's going to be fine. We'll probably see a slight increase in default rates, but I think high yield will be very good.
Anthony?
Yeah, can we go to page 75, please? This is for private capital. Generally, I think I've probably done this same slide for multiple quarters now. It's been positive generally, but private credit and real assets have outperformed or kept up with private equity. even though they tend to be lower risk and have lower correlation with the rest of the portfolio. So that's a lot of why we've been focused on those areas over the past couple of years, and still are. And so that's where, I guess, to answer Lyle's question, that's a lot of our areas of focus. We could go to the next page, please. This is real estate. Things are starting to turn around. You're starting to see a little bit of appreciation in some of our exposures. Mostly the returns here have been kind of just mostly income returns for the past couple of years, and offset by some write downs of the asset values. But we're starting to see those flatten out. I think the lack of new supply in a lot of areas is starting to benefit this asset class. You can hear it in the public calls and also our managers. The rent growth has obviously slowed down, or gone negative in some areas, like apartments in the most overbuilt places. But that stuff is starting to turn as the lack of supply that was a result of all the interest rate hikes is starting to really show up. So I think one thing that is good about our exposures here is that our funds have mostly avoided the redemption queue problems that a lot of other real estate funds have had. Two of them have cleared it multiple times, and all of them have been raising money and actually deploying some. So, all right, we go next page after that. Real assets. I think energy, of the war, data centers pretty much dominate the headlines here. We have other exposures as well that are also involved in keeping our economy going. And when things are constrained like they are with the war, they actually benefit because they have the capacity, they have the assets that are scarce and can drive returns. So that's again an area of reason why we've been focusing here. Unlike, say, private equity or other areas where there's still tons of capital out there, there's been lots raised. There's been not a lot returned. So we tend to try and go to areas that are where the supply demand is more in our favor. And so this tends to be one of those areas. So, all right. And then on the next page is private equity. Here you can see that there has been some more activity, but when you dig into it a little bit, it was really some mega deals that really did a lot of the value. If you took those out, it's still been pretty stagnant. The bid ask is still there. Obviously, rates are much higher than they used to be when many of these deals were struck in 21 and 22. So that's why a lot of people are still stuck. And so the things that are transacting tend to be really good assets. And they're going at pretty high multiples. And so that's kind of the things we're hearing. We've had a couple of managers who've made good exits and returned us a decent amount of cash. But it'll be interesting to see what happens with the rest of these portfolios. And I think that might be it. Oh, yeah, here's the next question. Yeah. Here's some examples of the things that we got liquidity for. You can see on the bottom right corner, those are some deals that our managers were able to sell for real, not continuation vehicle, but to an actual third party who paid a market price for it. So I think that was something that is good to point out. You can see in the middle, continuation vehicles. We've presented a few of them to you. We don't do most of them, but this has been a growing area of secondaries. Again, another area where there's a lot of capital raised and a lot of capital looking to put to work. But at least their incentives are a little better in those because usually they probably have to be some of the better assets that remain in managers' portfolios. Otherwise, they wouldn't make it to market. And so, and then you're basically arbing the people who have to sell. So that is something we've thought about. But yeah, there's a lot of people getting into it. So we haven't done anything specific with a dedicated manager, but we obviously have participated in a few of them. And that's it. I think I'm happy to take any questions there.
Anthony, where do you stand on all your called assets? Who's lagging and who's not?
Sorry, could you explain that a little bit? Like, what do you mean, like called assets? Like who's been calling capital, who has not been calling capital?
Yes, correct.
I don't think we view it that way. I think we have the managers, once we've obviously done a lot of work, getting to know them and how their investment style is and what their history's been. So I think that, if and when they find deals that are good, think they'll put it to work. We never want people to transact just to transact or because they have to. That usually doesn't end up well. So we've seen that a lot in our real assets portfolio. Our farmland manager was, relatively slow to deploy, but that's because you can't just buy large blocks of things to put that money to work. And if you could, maybe you wouldn't want to do that. So,
Lyle, to help, are you talking about approved investments, the calls that we've approved?
Correct.
Okay, that's what I think he's asking, Anthony.
yeah, that's the same. That's the question I answered.
Okay.
Like the farmland manager, I think took 2 years to call our capital.
Yes.
Our barge manager is similar. They took a couple years, but I mean, they did a very large deal last year that cleared everything. They raised some more money for other potential things that they haven't done quite yet. But yeah, they obviously, in some of these areas, they're specialists and they see everything. It's not marine leasing is not a huge industry, so they obviously see all the deals. They can afford to wait around and see when people get to a price that is something that they're willing to pay. And similar in some of these other areas that are more focused. So,
well, let me ask you this.
Yeah.
Then any approved assets, investments, right? Was there any change from what you expected to be calls, to the good or the bad?
No, I mean, not really. I mean, we have the rail allocation we got that you all recently approved. That is a potentially public deal that, I mean, obviously hasn't been announced yet, but if it happens soon, that would be called down later this year, but it's not deployed yet. So I wouldn't say there's anything that's been out of expectation, I would say.
Yeah,
I'm not sure if I'm answering your question. Yeah.
Yeah, I think the ones where we've expected, there tends to be a driver for quick, and the original ITE investments or the original railcar investment, we expected a quick deployment and it was successfully deployed quickly. I think for across private markets, it's kind of manager and sector specific, as Anthony touched on. With barge leasing, there's the opportunity set is not huge, and they tend to be larger size deals, some add-ons. So capital comes, but we tend to be supportive. Primarily because if we look at, say, the sports franchise, you want your manager to be prudent in passing on opportunities that they don't believe make economic sense. And we've seen that with, and it's across private markets. There's a lot of capital chasing, sometimes not a lot of deals or a lot of opportunities. And our managers have to be able to walk away despite doing a lot of work when the economics or I hate not dumb money, but maybe hopefully not as practical money is willing to overpay for assets. So I think they're timing wise based on the expectations when we make the commitments. For the most part, have been pretty consistent. I think maybe a little slower in some parts than others, but again, that's going to be manager and asset class specific. But really, for the ones where we've, as part of the recommendation, is we expect fast deployment, and we've highlighted that in the recommendation. Those have come to fruition.
Good. Thank you.
Okay. Specifically, you mentioned the sports investment, and I'll throw in there, and they may have already called everything. The agriculture investment, I forget what the name of the now that we did a few years ago. Where do those two stand as far as called assets?
Sure. The farmland has been called. They've closed our fund because there's a lot of unrealized gains, so they didn't want those to be diluted by newer investors. Again, something that's been impacted by data centers. You wouldn't necessarily associate those two, but that's what's been happening. So that's been called. In terms of, I forgot, what was your question before that? The sports. Oh, yes. That's mostly deployed, committed, but it hasn't necessarily been called. They use a credit line. And then also they tend to they structure in their transactions. So you might pay a third of it today, and then another third in a year or two, and then another third. That's how one of the NFL deals recently has been structured. So that helps with IRR and deployment. So they put that into a lot of their deals. So there's different structures like that. I think page 117, let me look at that. I mean, they put that in details here. If you have questions on that on page 117, that's by manager. So if you have specific questions, I mean, there's a lot of managers on here. So many of them are older and not in a phase where they're calling capital actively. But we're happy to answer any questions if you have specific ones. We can go through them all. We talk to our managers pretty regularly about these things. I mean, just to tell you about the sports one, obviously you've probably seen there's been a lot of transactions recently. I mean, they get a lot of attention. And our folks have obviously seen them and can tell us what the valuations they had, what they went off at, differences that they have, why. We've seen that another one of our real estate managers, there was a spinoff of a public company that happened. And so I wrote them and was like, obviously I knew they must have seen that and they did. And their valuation was X and it went off at 33% more than X. And so they're like, we have no idea how they penciled that out to a private equity firm that's not in the industry. So, but, Godspeed. So yeah, that's those are the details we can get from folks because we are important capital and we're in contact with them regularly to understand what's going on in their areas.
Did I see somewhere where there's been another couple of firms approved for purchase by the NFL?
No, it's still the same four. It's still 6th Street and Arctos and Ares, and then the consortium, which I don't think is transacted yet. That was Blackstone, CVC, and a couple other folks.
I think
So as far as I can tell, it's still those four. There have been more deals. The Raiders sold a stake recently. Arctos was involved in the Cleveland Browns stake. So, I mean, the owners meet quarterly. So then out of those meetings, then some approvals happen. And so that's why you probably see them in the news.
Okay.
Any other questions? Is that pretty well complete presentation, Steve, or?
I'd like to touch on one last, and that's page 95. Very briefly touch on this. Again, this is one of my favorite Wilshire charts. And all I'll say here is, while we focus a lot on absolute performance of the portfolios, and that's obviously very important to all of our metrics, it's also important to consider the risk that the portfolios are taking to achieve that level of performance. We've talked a lot about that kind of in today's discussions, and just really to highlight that all of the pension and insurance portfolios have really produced exceptional risk-adjusted performance over the 1, 3, and 5-year time periods, and that's based on Wilshire's All Public Plans universe. And I would note there on the far right, with all of the portfolios producing Sharpe ratios in the top 5% of Wilshire's peer universe over a 5-year period. So I think that's really important to us. The investment committee and the board kind of provide us those asset allocation guidelines that we talk about. That's our marching orders that specifies, risk parameters and constraints under which staff constructs and manages the portfolios, and all of the risk-adjusted return measures really demonstrate the efficiency of the performance that the portfolios are producing. So we just think this is an important slide. So I'll cover the investment budget if you want, or in consideration of time, given that it was presented at the CRS Finance Committee. I'm happy to move along as well. So
I think we're fine. Please move along. Right.
Okay, that would conclude what we have.
Okay, thank you so much.
You're welcome.
Given the time frame, I'm not sure. The next, anything in the compliance report, Carrie? Is that?
Nothing negative to report, so I was just going to summarize that and ask for any questions. Otherwise, happy to move along.
Okay, well, thank you. I think we'll be fine with this continue stop here. I think the last item, the IPS amendment, I would prefer to delay that until our next meeting. We're a little bit pushed for time this afternoon, and give us some more time to think about that, if that's okay with everyone. Any objection to not taking that up today? It seems that's more of a long-term issue.
I don't have an objection to it. Bill had to leave, so we're just down to the three of us anyway.
That's what I was thinking. I just didn't have that more of our committee here for those conversations. So, okay. With that, I think we're ready to adjourn the meeting. Thank you all for being here this afternoon, and have a good weekend. And let's hope this good weather continues.
Thank you very much.
Great.
Good to see everyone.
I know. Yeah.